So what we're going to look at in this video is the Chapter 7 homework assigned from the McGraw-Hill textbook that we use in this class. So what we're going to see is in Chapter 7, we're primarily dealing with the valuation of accounts receivable. And in this question, what we're going to really look at is how do we handle credit card sales. So up until this point, we pretty much just said when we make a sale, we debit either cash or accounts receivable, we credit sales revenue, and we move on. But in this chapter, we look at what happens when someone pays with, say, a Discover card, a Visa card, whatever the case is, some credit card. Well, these credit card companies charge a fee to the companies to allow them to accept these types of payment. So you say, well, then why would management accept these types of cards? And if you think as a consumer, when do you try to pay for something with cash? It's fairly rare at this point. Now most people pay with stuff with a debit card or a credit card. So the company has to look at this and say, well, would we rather keep 100% of our sales for ourselves but have less sales, or keep maybe 95, 96% of those sales and have to remit a portion of that to the credit card company? And almost every company is going to decide they're better off making the sale and having to pay a small fee than not making the sale at all. So that's what's happening here. So in this question, it tells us we want to prepare the journal entries for the following sales transactions on the credit cards. So the first one tells me that we sold $26,000 worth of merchandise, which had a cost of $19,800 on MasterCard credit cards. And MasterCard charges a 5% fee. So when we do this journal entry, we know we're going to have two journal entries. The first journal entry, we're going to record the sales revenue. So we're going to record the revenue related to this. And finally, we're going to need to record the expense, meaning the cost of goods sold portion of this. So if we look at number 1 right here, what we see is that we debit cash for the $24,700. And you say, well, how did we get that? So let's, instead of starting right here with our cash, let's instead start right here. We made a sale. We know that $26,000 worth of sale is revenue. So this is what we've been calling up until this point in the semester sales revenue. And that is $26,000. We know sales revenue is an income statement account. So we know what's going on right here. So then the next piece says, well, where did this $1,300 and this $24,700 come from? And the answer to that question is that to get this $1,300, what we're going to do is I'm going to take the amount that the credit card company is charging me, which in this case is 5%. I'm going to multiply that by the total that I just sold of $26,000. And when I do that, I'll calculate my $1,300 in sales that is going to have to be reported instead of as a cash receipt for us as a credit card expense. Because this is going to be related to this 5% fee that MasterCard is going to charge us. Now we've gotten this $1,300, so the way we're going to get that $24,700 is just with simple subtraction. So we're going to say, well, I've got a $26,000 sale. By the time I back out my $1,300, that'll pull me down to the $24,700 in cash you see reported here. So that's all that's going on. So hopefully not too terrible. So now we'll move on to the next piece. So that handled number 1. So now we're going to look at number 2. So now we're going to look at how we record the expense associated with this sale. And this part's easy, right? It's just what we've been doing since we covered inventory a few chapters back. And we're told the cost of this inventory is $19,800. So what we do is we're going to debit the income statement account, cost of goods sold, and it's going to increase because it is an expense, and expenses increase with the debit. And then we will credit our merchandise inventory account, which is our balance sheet account, which shows us exactly how this has now been moved from the balance sheet over to the income statement. So we've seen this chart a few times, but I'll draw it back up here again. So we always say when we talk about inventory that there's a few moving pieces. You've got beginning inventory plus your purchases, which gives you something that we call cost of goods available for sale. And then that has to end in one of two locations. It either ends in ending inventory or in cost of goods sold. And if it ends in ending inventory, this goes on the balance sheet. But if it ends in cost of goods sold, this goes on the income statement. So that's all we see here. So when we do this transaction here, all we're doing is showing how this is flowing from where it would have ended in ending inventory to now it goes to cost of goods sold. Because once something is sold, it can be moved to cost of goods sold. So that handles the very first question that we were asked here. So now we're going to look at the second question, and we'll begin like we did with the first one, looking at the revenue side. So here it tells us we sold $5,600 of merchandise, which cost $3,300 on an assortment of bank credit cards, and these charge a 4% fee. So you'll look and you'll see that this is handled very similarly to how we did the first one. So we'll start with that credit to sales, which once again, we would normally just call sales revenue for $5,600. And then the amount that I'm going to record as credit card expense, that's going to be my 4% that the bank is charging me times the amount of sales of $5,600. And that will give me $224. And then that comes in right here. Now the way we get this $53.76, of course, is really just a plug. So we'll take our 5,600 minus my 224, and that'll give me 5,376 for my actual cash received. Okay. Now, for the next piece here, what we're going to look at is how the cost is handled. And you'll see it's the exact same way we did it in the last question. So we debit cost of goods sold, and we credit that merchandise inventory account. So we see cost of goods sold going up because it's an expense, and expenses increase with the debit. And we see merchandise inventory coming down because merchandise inventory is an asset, and an asset being credited reduces the balance in that account. So we've now handled the first question, so we'll move on to question number 2. So in question number 2, what we're going to look at is what we call the direct write-off method. And what the direct write-off method does is it is a way that we can use to record when our customers are not able to pay us. Now, a couple of things you want to know here. One, this is not GAAP, meaning this cannot be used for financial reporting. However, this is used for tax reporting. So what's going on here is GAAP is very concerned with what we call the matching principle, which says I want to make sure that I match any expenses to the revenue that they helped us generate, which means if I record a sale in year 1, then the cost related to that sale arising from this inability of our customers to pay should also be placed in year 1. However, the direct write-off method does not record this expense until we know the customer cannot pay us, which may not occur, for example, until year 2, which is going to create a mismatching of revenue and expense. This is why we cannot use the direct write-off method in most cases under GAAP. The textbook does have a small exemption if it's a non-material difference, but in general, we're going to say you cannot use the direct write-off method under GAAP because it does not follow this matching principle. So that covers briefly what we're going to be talking about here. So let's see exactly how this works. Well, this is the easiest of the methods we'll talk about because it is so direct. So the way we're going to handle this is it tells us Solstice Company determines on October the 1st that it cannot collect $57,000 of its accounts receivable from the customer. Apply the direct write-off method to record this loss as of October the 1st? Well, in this case, we're going to debit what's called bad debts expense, and this is a new account in this chapter. So don't be worried if that doesn't sound familiar. This is probably the first time you've seen it. So we're going to debit bad debts expense, and just like every other expense, it's going to increase with a debit. Now, if we think about this, what happens when an expense increases? Let's just take this to the next step here. So when an expense increases, what's also happening is equity is decreasing. And that's because expenses work to reduce equity, whereas revenues work to increase equity. So we want to make sure we kind of see this whole picture coming through. Now the next thing we've got to do is we've not just got to record this expense, but we've also got to show that we no longer expect to collect this money from this customer. So then what we have to do is take down our accounts receivable from the customer in question, and here is P more. So what we see is that we now show an increased expense on the income statement and a decreased asset on the balance sheet. So if you wanted to look at this in an accounting equation format, what you would see is our basic accounting equation of assets equals liabilities plus equity. And because an expense has increased, equity has decreased. And because we have credited an asset, assets have decreased. So we have remained in balance. So this works pretty well. And that's all that's going on here. So that is the end of question number 2. And now we'll move on to question number 3. So in question 3, we're going to look at a certain situation that says, well, what happens when we need to recover a bad debt? So the first question you should ask is, well, what does it mean to even recover a bad debt? Well, what we're going to do is we're going to say, at some point we figured out a customer was not going to pay us. And when that happened, we wrote that account off. However, if a customer then decides they are able to pay us at some point in the future, maybe they got an unexpected bonus at work or they won the lottery, whatever happened, now they've got the money, now they can pay us back. Are we going to just deny that money? Are we going to tell them, no, don't worry about it, we already wrote it off, you're good to go? Of course not. If they can pay us, we're going to want that money because that's going to help the business continue on. So what we're going to do is we're going to have to restore that account to begin with. So let's see what we're doing here. It tells us Solstice Company, which uses the direct write-off method. Make sure you always know exactly which method is being used because the entries may vary just a little bit depending on if you're using the direct write-off method or the allowance method. And it tells us that Solstice Company determined on October the 1st that it cannot collect $70,000 of its accounts receivable from P. Moore. But on October the 30th, he paid us in full to the Solstice Company. So this has 2 parts. Okay, that first entry is going to work to restore the accounts receivable, AR, right, accounts receivable, that had been written off. And the second thing that we're going to do is actually show the collection of cash. And so in this first one right here, what we do is we think, well, what happened in that last journal entry? And in that last journal entry, and in fact, we can just scroll up to number 2. What we see is a debit to bad debt expense and a credit to accounts receivable. Now, you can see the numbers have changed, right, because these are algorithmic. But if this was not algorithmic, right, and this was $70,000, then it would be a straight reversal of this right here. And back and forth. So what we did is we said initially to write off under the direct method, under DM, what we did was a debit to bad debt expense. And I'll probably be abbreviating this from this point forward as just BDE. And we credited that accounts receivable per P. Moore. But now we found out he can actually pay us. So what you see in number 1 is just a reversal of the write-off. That's all that's happening here. And then in number 2, and this happens immediately, right? We restore the accounts receivable on the 30th. we collected payment on the 30th. So then we debit the cash, because that's how he's going to pay us, is with cash. We know cash is an asset, so cash is going up with a debit. And we credit the accounts receivable. And accounts receivable is also an asset, and if an asset gets credited, it decreases. Okay, so now we've seen how we're going to restore and actually collect cash on a previously written off account under the direct write-off method. So now that we've wrapped up number 3, we'll move on to number 4. All right, so now in question 4, what we're going to look at is distinguishing between the allowance method and the direct write-off method. So this question just gives us a few statements. We're going to have to pick, is this a characteristic of the direct write-off method or of the allowance method? So we'll just go down through these and kind of talk about them as we go. So when an account is written off, we debit the allowance for doubtful accounts. Well, under the direct write-off method, we just debit bad debt expense. So we know that can't be the direct write-off method. So we know that must be the allowance method. Now for the second one, it tells us that we match the estimated loss from the uncollectible accounts receivable against the sales they helped create. And we said this was the main reason that the allowance method was acceptable under GAAP and the direct write-off method was not, because the direct write-off method does not do this. The direct write-off method just waits until we know that you cannot pay, and then we record that. Next, it tells us when an account is written off, the debit is to bad debt expense, and that is the direct write-off method, which is what we've been saying. Which method does not predict bad debt expense, and once again, that is also the direct write-off method, and that is because we're not making a prediction. We just record this whenever the customer tells us they're going to be unable to pay us. Next, we see that the accounts receivable on the balance sheet is reported at net realizable value, and that is the allowance method. And net realizable value is gross accounts receivable less your allowance for uncollectible accounts. And that will give you net realizable value, which is often abbreviated as just NRV. So the reason this has to be a characteristic of the allowance method is the direct write-off method doesn't even use the allowance for uncollectible accounts account. So we know that can't be part of that method. And finally, the write-off of a specific account does not affect net income. This is the allowance method also, and we'll talk about this more later when we actually see something get written off under the allowance method. But for now, just know that is a characteristic of this because we actually hit net income when we made the sale, right, in that same period, not when that actual write-off occurs. So we want to make sure that we understand that, and that brings us to the end of question 4. So now we'll move on to question number 5. Now, for question number 5, what we're going to look at is the percentage of sales method. And the percentage of sales method is what we call one of our allowance methods. So this is where we're going to actually see how these allowance methods work. Specifically, you'll often hear the percentage of sales method referred to as the income statement method. And so what this means is that the focus here is that we are trying to emphasize the matching of this expense to the sale because we're going to base it on our sales. Now, in most cases, we're going to base this on our credit sales, not our cash sales, because if I've received a cash sale, there is nothing left to be received. I've already gotten the cash, which means that the only portion of my sales number that might need to have an adjustment made for it is going to be this portion that was sold on credit. Now, for simplicity, you may every once in a while see someone use total sales instead of credit sales, but if that's the case, it's typically going to be a lower percentage than what you would see if you just used the credit sales number. So just keep that in mind as we look at this question. And the first thing I want to tell you is that with the percentage of sales method, what we are going to calculate is the actual adjustment, which means that I do not need to consider the beginning balance in my allowance account when I make this adjustment. I only need to look at that if I'm looking at maybe what is the net realizable value of this, which once again is just my gross accounts receivable less that allowance for uncollectible accounts. Or if I was asked for the ending balance in my allowance for uncollectible accounts. That's the only time I would need to know what that beginning balance was if I was using the percentage of sales method or the income statement method, right? It's two names for the same thing. So what we're going to see here is that at year end, so at December the 31st, Chan Company estimates its bad debts as 0.3%. Goodness gracious. As 0.3% of its annual credit sales of $892,000. Chan records bad debt expense for that estimate. On the following February 1st, Chan decides $446 of the account related to P Park is uncollectible and writes it off as a bad debt. On June the 5th, Park unexpectedly pays the amount that was previously written off. So this is going to take us through every possibility underneath this percentage of sales method. We've got the estimate, we've got the write-off, the recovery, and the final collection of cash. So we'll talk through exactly where these numbers come from and what these accounts are doing in each one of these journal entries. So at the end of the year, we're making our estimate for how many accounts are going to be uncollectible. And in this case, it tells me that I have 0.3%. So I'll take 0.30% times my $892,000, and that will give me $2,676 that is going to that bad debt expense in this period. At the same time, I'm going to have to send that to that allowance for doubtful accounts. So my bad debt expense is going to increase here because it's an expense. And if an expense is increasing, what's happening to equity? Well, the answer, of course, is that if an expense increases, then equity decreases. So now how are we going to keep this accounting equation in balance? Well, the other side of this is a credit to allowance for doubtful accounts. And you say, well, what type of account is this allowance for doubtful accounts? And the answer here is that this is a contra asset. Now, this is not the first contra account we've seen this semester, but it is another one that we're going to have to deal with. And just like all of our other contra accounts that we've seen, anytime you have a contra account, it pairs with a related asset in that section of the financial statement. So in this case, what we're talking about is, of course, the balance sheet. So assuming these are current receivables, what I would see is on my balance sheet, I'm just going to do an abbreviated balance sheet here, just for simplicity. What I have is my current asset section, and I would list cash, short-term receivables, investments, inventory, all those types of items in this section. Then somewhere down in here, I've got accounts receivable. Now, what I'm going to do is I'm going to come in on the line right below that, and I'm going to write less allowance for uncollectible accounts. You may also see this as allowance for doubtful accounts, which would be AFDA. This textbook seems to kind of go back and forth. So in this case, I'm just going to use AFUA, but it's the exact same as AFDA. Okay, so just be aware of that. So in this case, what you then see is our net realizable value for accounts receivable. Now, it is possible for a company to, instead of reporting like this right here, they could opt to just report accounts receivable net on the face of that financial statement and then show in the notes to the financial statements exactly how this computation came together. So just be aware, they could go either way, but both of these are acceptable presentations as long as it's in that current asset section. But because this allowance for uncollectible accounts or allowance for doubtful accounts is a contra asset, it will pair directly to the related asset which in this case is accounts receivable, and work to reduce that balance. And in the case of accounts receivable, that has a special name that is called net realizable value. So we want to make sure that we see all of that and understand exactly how all of this is working together. Okay. Now, for the next piece, what we want to look at is the second journal entry, and it tells us here what we're wanting to do is to come in and see exactly where this entry on February the 1st came from. So it tells us on February the 1st, Chan decides $446 of the account related to P Park is uncollectible and writes it off. So when we make this actual write-off, now what you'll see is in December 31st, we already recorded that expense, which means on February the 1st, I no longer need to record an expense. So what is the impact on net income in year 2 related to this write-off? There is no impact in year 2 on net income. And you say, well, why not? Because that expense has already been accounted for in year 1. So we do not see a direct impact on our income in year 2. So you say, well, what about the current asset section of the balance sheet? Is that affected? So let's just see here, and I'm just going to make up nice clean numbers, and I'm not going to use these, but I'm just going to say, let's just imagine for a second, I had accounts receivable of $1,000, and I had allowance for uncollectible accounts of $200, which would give me a net realizable value of $800. Now, if I then come in and say I write off $100, so I take $100 out of my accounts receivable, so I do minus 100, which gives me 900 here, and I do minus 100, which gives me 800 here. Oh, I'm sorry, not 800 there, which gives me 100 right here, and then gives me 800 as my net realizable value. And you'll see the balance sheet in total is not actually affected either. The only thing that is really affected here is the form, as we're just moving money between the accounts receivable and the allowance for uncollectible accounts. So now that we've seen that, we now understand why on the question where we had to talk about the characteristics of each, why we were able to say that there would be no impact on net income from this transaction. So what we do is we debit that allowance for doubtful accounts, and that allowance for doubtful accounts now is going to be going down because it is a contra asset, which means it pairs with the related asset, but it behaves in the opposite manner. So since it's a contra asset and a normal asset would increase with a debit, then a contra asset must decrease with a debit. And so then my accounts receivable is also being written down, and that is a regular asset. So with a credit, a regular asset goes down. And that's exactly what we see here. So that takes us through the end of the second part of this question. Now the third part here, it tells us that on June 5th, they unexpectedly paid us the amount that we previously wrote off. So what this tells me then is that now I've got to come in here and actually restore this accounts receivable and then collect that accounts receivable. So in this case, when I need to restore this accounts receivable, what I'm going to do, I'm going to increase my asset, the accounts receivable account itself, by $446, which was the amount previously written off. Okay, right there. It was written off, but now it's being restored. So this just comes straight down. And then what we need to do is say, since we didn't actually end up having to write this off, we need to put that balance back into that allowance account so that it's there if someone else needs us to write off something. And so that's just going to flow down through. And so this is really just a reversal of the entry made on February the 1st. Now the last piece of this, of course, is they actually paid us. And since they actually paid us, then what we were able to do is come in and say cash is going to go back up and accounts receivable is going to go back down. Both of those are assets. So cash, the asset, got debited, so it increased. And accounts receivable, another asset, got credited, so it is decreasing. And if we go back to this first entry on June the 5th, we'll see that the allowance for doubtful accounts is also increasing. and that's because it is a current asset that is being credited. So that brings us through to the end of this question. So now we'll move on to the next question. Okay, so for number 6, we're still going to be looking at the allowance method. So this is another allowance method. But this time, instead of basing it on the income statement, we're going to base it on the percentage of accounts receivable. Now, this method is often referred to as a balance sheet method because accounts receivable is an asset and assets are shown on the balance sheet. So in this case, there is going to be a key difference from what we did in the last question. And in this question, the beginning balance in this account absolutely does matter. Now, in the last question, I told you whatever you did for that basic calculation would give you the amount for the journal entry. That is not true if you're using a balance sheet method, and we'll see that as we work through this question. So this question tells us that Mazie Supply Company uses the percentage of accounts receivable method. And so let's make sure we know the method. And on December 31st, we have outstanding accounts receivable of $122,500. And we estimate 4% will be uncollectible. So the first step here then is to just take my 4% times $122,500. And when I do that, I'll get $4,900. So what that tells me is that when I look at my allowance for uncollectible accounts, so that's the T account we're drawing here, my allowance for uncollectible accounts, I'll have a beginning balance and I'll have an ending balance. In this case, that ending balance is going to be this $4,900. So now for assumption A, I'm told my beginning balance is $2,083. So what we want to see is how much in bad debt expense needs to be recorded to bring this allowance for uncollectible accounts all the way up to $4,900. So if we take $4,900 minus my $2,083, so this is my ending, minus my beginning, then what I'll see is I still need $2,817 to actually get us all the way up to this $4,900. So that's $2,817. Now, just for the sake of completeness, I'm going to jot down on the left side of this account what would have reduced this allowance. And just like we saw earlier, what this is if we'd had any write-offs, then those would have gone as a debit to the allowance for uncollectible accounts. So what I suggest is anytime you have a question that's dealing with the allowance method, specifically a balance sheet method, then what I would do is I would draw up this T account and I would just label at the very beginning balance, current year bad debt expense, ending balance. Those are all going to go on your credit side. And I would immediately jot down write-offs on the debit side or on the left side. That way you've got yourself set up, and now it's just a matter of plugging in numbers. So that's the way that we handle situation A. And the journal entry is exactly what we saw earlier, where we debit bad debt expense, which because it's an expense is increasing, and we credit allowance for doubtful accounts, which because it's a contra asset being credited, it is also increasing. So that handles the first question. Now the second question, and I'm just going to clear out some of this. Oops. Just so we have it, is to do this, but now instead of beginning with a credit balance, I'm now going to begin with a debit balance. So in this case, I actually have a non-normal beginning balance. So in this case, I began the year with a $613 debit balance, which means in the prior period, I didn't estimate enough. I had too many write-offs. So I've now got this $613 as a debit, but I now need to get to $4,900 as a credit. So we know the amount of the adjustment then has to begin with that $4,900. But the question is, if I just use $4,900, is that going to bring my ending balance to $4,900? And the answer is, of course not, because we began with a debit balance of $613. So if you think about this just as a number line, what you're looking at here is we need to get all the way to $4,900. But to go from $613 as a debit all the way over to $4,900 as a credit, I need to first cover this $613 and then cover the $4,900. So instead of subtracting these like we did a second ago, what I'm going to do is I'm actually going to add them together. So I'm going to say I need my $4,900 as a credit. I'm going to add in my $613 that was my debit beginning balance. And that will tell me that the amount of my adjustment needs to be $5,513, which you see right here. And once again, the accounts are the exact same as they were just a moment ago. So hopefully not too terrible. All right, it's a little bit different because in the prior question to record the journal entry, all we needed was to take that amount that we expected to be uncollected, which we said was, 0.3%, and we multiplied that by this 892. And when we did that, we got this 2,676, which was the amount of our adjustment. However, when we are dealing with a balance sheet method, that will no longer suffice, because what we now need to do is come in and say that will not be enough because we've got to take into account these beginning balances. So what I'm telling you is if I give you a beginning balance and I ask you for the percentage of sales method, please don't get confused and accidentally use that in your calculation. All right, the question may give you additional information you don't need, so be sure you know what information you need for each method. Yep. So now that we have completed number 6, we'll move on to number 7. So in this case, we're once again going to be looking at estimating bad debts. So let's see exactly what this question wants us to do. It tells us that December 31st, Folgers Coffee Company reports the following results for its calendar year. Cash sales of $914, credit sales of $314, and in its year-end adjusted trial balance, we include the following items. Accounts receivable, $139 as a debit, which is the normal balance, an allowance for doubtful accounts of $6,400, and notice this is a debit balance, which is a non-normal balance in this allowance for doubtful accounts. So we're going to have to consider all of that as we work through this question. So this question asks us to prepare the adjusting entry to record bad debt expense, assuming uncollectibles are estimated to be 5% of credit sales, 3% of total sales, and 8% of year-end accounts receivable. So these first two, they're not going to be too terrible. For the first one, all I've got to do is come up here and I see that my credit sales are $314,000. So I will take my 5% estimated credit sales, multiply that by $314,000 of total credit sales, and I will come out to $15,700 for my adjustment. Now notice this is an estimate of credit sales, and since it is a sales estimation, this is what we refer to as an income statement method. And if you recall earlier when I talked about the income statement method, what I told you was that when you calculate the amount for an income statement method, what you are getting is the amount of the adjustment. And sure enough, that's exactly what you see here. Okay, so we completely ignored the beginning balance in this allowance for doubtful accounts because it's not relevant to this piece of the question. So for number 2, they tell us, well, now we're going to use 3% of total sales. So we're not just going to apply this to the credit sales, which is the portion that could actually need this adjustment. Instead, for simplicity, we're just going to add up all of our sales. I'll take 3% of that. So in this case, what I'll do is I will take my 3% that we expect times, I'm just going to open a parentheses here. I'm going to add my cash sales of $914,000 plus my credit sales of $314,000. And whatever that comes out to, this 3% times this joint amount, will tell me how much I need to make this entry for. And in this case, that comes out to $36,840. And sure enough, you see that adjustment right there for those amounts. And once again, we've got the same accounts we've had in each one of these problems so far. Now for this next question, we need a bit more room, so I'm going to clear out the work that we've just done. And I'm going to move on to number 3. So for number 3, what we're going to look at is exactly how we're going to do this, but now it's based on accounts receivable. And since it's based on accounts receivable, what that means is that this is a balance sheet method. Now, I didn't point it out a second ago because it's just like the one before it, but once again, here, this total sales, this is an income statement method. So we've got 2 income statement method calculations and 1 balance sheet method. Now, if you remember the balance sheet method based on accounts receivable, that method, we do not directly calculate the adjustment. We instead directly calculate that ending balance in the allowance account, and then we have to back into how much that adjustment actually needs to be for. So what I'm going to do first is I'm going to come over here, and I'm going to draw me up, I'm going to draw up my T account for my allowance. Okay, so for my allowance for uncollectible accounts, what I'm going to do is I'm going to take the information they've given me. And it tells me that allowance for doubtful accounts began with a $6,400 debit balance. So I'm going to label that. Then I'm going to put in WOs, which would be if I had any write-offs. Then I'm going to come over here, and I'm going to say my current year bad debt expense. And finally, I'm going to have my total. So we've got our T account set up so that now we've just got to plug in the information as we get it. The question then tells us we use 8% of year-end AR, and they were nice enough to tell us the year-end unadjusted trial balance includes the following items. And one of those items was this accounts receivable balance. So I'll take 8% times my $139,000. And if you do the math on that, you'll come out to $11,120. But remember, this is $11,120 as a credit. So if we go back to that number line just to help us visualize this one other way, what I'll see is I began with $6,400 as a debit. $0 will clear that, and then I need $11,120 extra to get me to this ending balance we need. So if I take my $6,400 beginning balance plus my $11,120 that I need in my credit balance, I'll come out to $17,520 that needs to be used for my actual adjustments. There's a little bit more work with the balance sheet method, but it's not too bad. We just have to take our time and make sure we stay organized, and we can get through this no problem. So hopefully that one made sense, and now that we're done with that one, we'll move on to the next. For this next question, what we're going to look at is exactly how we handle notes receivable transactions. So in this question, our given information is right here at the top. It kind of blends in, so don't miss it. It says, the following transactions occurred for Danica Company. On December the 13th, we accepted a $24,000, 45-day, 8% note, granting Miranda Lee a time extension on her past due account receivable. Prepare the adjusting entry to record the accrued interest on the note at the end of the year. So, what they're asking us to do here is to break this interest into 2 pieces. The first piece says, well, how much interest is going to accrue on this over the entirety of the note, and how much interest is going to accrue on the portion before the end of the year. So that's what we're going to look at. So if you remember, the basic formula that we use for interest tells us that interest is equal to principal, which is the amount borrowed, times rate, which is the interest rate that we're charging, or being charged, times the amount of time. Now in class, I always tell y'all to keep time over 12 months, and that's true. But in this case, we were given interest on the amount of days. They told us to say 45-day note, so we're going to want to keep time based on 360 days. And they tell us that right here. Use 360 days in a year, not 365. So we'll go ahead and do that. So for the total through maturity, I'm taking the full 45 days times the rate that they gave us, which was an 8% note. So this is 8% times the amount of the note, which was $24,000. And that'll give me the total interest over the life of the note. And if you do that math, it will come out to be $240. Now, if I want to do this just for the remaining portion of the year to make sure I get that accrual right at the end of the year, well, my formula is the exact same. Interest equals principal times rate times time still. But now, has anything changed? Well, the principal's still the same. All right, we didn't loan you a different amount of money. The rate is still 8%. The time is still over 360 days. So the only thing that changes is this numerator in this last fraction. And that numerator is then 18 days because that is all that is left from the time the note was loaned until the end of the period. So now on the next screen, what we're going to look at is the actual journal entries. So on December the 13th, the entry that we need to make is a debit to notes receivable because we've essentially made a loan. So we have converted this account into a note. So we've done that. So we've got our debit to notes receivable. It's an asset getting debited, so it's increasing. And we're crediting the accounts receivable because we have gotten rid of the accounts receivable. That is an asset that is going down because it is being credited. And this shows that we've transformed this accounts receivable into a note receivable. Now the next piece here comes down and tells us about the interest. So if we scroll back up and we look and we actually do this math here, this comes out to $96. And this 96 is the amount that we're going to use in our adjusting entry right here. So just to keep it all on this page, I'll just jot it down again. So interest equals principal times rate times time. That's still my $24,000 times my 8% interest rate times 18 days out of 360, and that will give you $96. And that's exactly how we calculated this accrual here. So then what happens with the rest of the interest? Well, that's incurred or accrued for in the next period. Okay. So now that we're done with 8, we're going to move on to 9, but it's related. That's a related question, so we'll just keep moving through. So on this one, it tells us that we want to complete the table to calculate the interest amounts, and those calculated values will be used to prepare any journal entries that we have. So in this case, what we're given is several different transactions, and we'll just read through those real quick, and then we can just reference back to them as we need them. So it first tells us on January the 27th, we received a lease payment for principal and interest on the note dated December the 13th. So this is the note from question number 8. Then it tells us on March the 3rd, we accepted $18,000, or accepted an $18,000 6% 90-day note, granting a time extension on the past due account of Thomas Company. We then accepted a $16,000 30-day 6% note in granting H. Ching a time extension on his past due accounts receivable. Then H. Ching dishonored his note, and we wrote off that account against the allowance for doubtful accounts. So we wrote that off, and then we finally received payment from Tomas for principal and interest on the note dated March the 3rd. So there's quite a bit of information we're given here, but we're just going to kind of walk through it and see exactly what's happening. So for the Emily note, we're going to see some calculations that are pretty similar to what we had before because these two are exactly the same. So if you were to scroll back up to question number 8, you would see these exact calculations in that table. However, here we actually are just adding this last column that shows us exactly how much interest gets recognized in that period after December the 31st. So if we looked at this on a calendar, what you would see is from December the 13th to December the 31st, we needed to accrue for $96 in interest. And from December the 31st to January the 27th, we will accrue for $144 of interest. But over this entire period, we will accrue for the entire $240. And that's exactly what we see here. It just gives us more detail and allows us to break this down so that we may better prepare our journal entries in a more easily done manner. Okay, so that handles the first part of this question. So now we're going to move on to the Tomas note. And on the Tomas note, what we're going to look at is it tells us we accepted an $18,000 6% 90-day note. So just like we did the calculations on the last question, we're just going to take interest equals to principal times rate times time. This is $18,000 in principal times a 6% interest rate times 90 days out of 360 days. That will tell me the total amount through maturity. And you say, well, why on earth do we get to just calculate this one time? And that's because this note will mature within this 1 year. So we don't need to actually make this division across periods unless maybe we wanted to do that at the end of each month. But this question doesn't ask for that. So we're going to be okay just doing this one time, and this will give us $270 worth of interest. Now for the last question, we're going to look at the last note from H. Ching. And in this case, we got a $16,000 principal loan. We had a 6% interest rate. It was a 30-day note. And so once again, we have interest equal to principal times rate times time, which in this case is my $16,000 that was borrowed for the principal times the rate of 6% times 30 days out of 360. And if you do that math, you'll come out to $80 that needs to be recognized. Now in my general journal, we're going to look at the journal entries that need to be made on each date. So on January the 27th, we received interest and principal on the original note that we had given to Lee. So in this case, the amount of cash we receive is actually going to be the last thing we can calculate, unless we want to do it a little bit different. But we're not going to worry about any other methods to get to this number. I'm just going to show you the easiest way to get there. And then if you want to try to figure out other ways, feel free to do that. But I'm going to show you a way that you're not going to be able to get it messed up, and it'll help you keep it straight. So that's the way we're going to handle this one. So initially, the very first thing I would do is I would come in, maybe skip down a couple of lines, and I would take this credit right here first. Because this is the easiest part of this journal entry, because it's just given to us back in the prior question where we looked at how much this note was for. It was a $24,000 note. So now if they're paying me for that whole $24,000 note, what I know is that I can take that and reduce that note receivable by that full amount because it's now been paid. So this is an asset that is coming down, and it's coming down because it has been credited. The next thing I want to do is come in here and see, well, we said that from December the 13th through December the 31st, we needed to recognize $96 in interest. And from December the 31st to January the 27th, we needed to recognize $144 in interest. So when we did this entry on December the 31st, I'm just going to jot down real quick what we did there. All right, so if we scroll back up, I think we did it. Yes. So what we did is we debited interest receivable and we credited interest revenue. So I'm just going to jot that down now that we've shown you where this is coming from. We debited interest receivable, credited interest revenue, both for $96. So now when they actually pay me for this, and towards the end of January on the 27th, then what I need to do is actually come in and figure out, well, which one of these accounts is still going to be around. Well, what we didn't show you is at the end of December 31st, we come through and we do something that we do at the end of each year. And it's called closing our temporary accounts. So if you remember back in Chapter 3, when we first talked about closing entries, we said that you close revenue accounts, expense accounts, and dividend accounts. And your permanent accounts are assets, liabilities, and stockholders' equity. And we called these our cred pals. And they were going to help us remember which accounts needed to be closed and which accounts needed to remain open at the end of each period. So we close our revenues, expenses, and dividends. And our permanent accounts are our assets, liabilities, and stockholders' equity. So what we're doing here is we're saying, well, by the time we get all the way down to January 27th, which one of these accounts will still have a balance reflecting this $96? And the answer is this interest receivable account, because interest receivable is an asset, which means it stays on the balance sheet across periods and does not get cleared unless it's either written off or received in payment. So this interest receivable can still be used here. However, the interest revenue account would have been closed at the end of December the 31st. And what that entry would have looked like if we had shown it is we would have debited interest revenue and we would have credited retained earnings. Or in this book, I believe they take it instead of straight to retained earnings to income summary. But either method is appropriate in accounting outside of this course. Okay, so however you choose to do it is okay with me, as long as it's okay with the homework system. Okay, so that's all we see here. And that explains why this interest revenue account would no longer have a balance. And it's because it was first credited for $96, but then we turned around and debited it for $96, eliminating that balance. Which means the only account that can still be used to reflect this $96 is the permanent account that was that interest receivable. Okay, so now we've addressed that. Now the next piece is, well, what do we need to do to deal with the current interest? And in this period, we need to deal with the interest revenue, because that will put the revenue in the proper period, which is in this new year. So that 144 simply goes there. Now, if you take your 24,000 plus your 96 plus your 144, what you'll come back to is the total cash that we are receiving of $24,240. So we'll just jot that down real quick just so you can see that one more time. So 24,000 plus 96 plus 144, and that will come out to $24,240. Now, one other way you could have gotten to this number is if you came back up and you realized the total amount of interest that we were going to calculate on this note was this $240. Well, that means at the end of the period, the amount owed to us is enough to cover not only the $24,000 note, but also the $240 in total interest, which would still get you to the same $24,240. However you choose to get there is totally fine with me. I do recommend breaking it into at least 2 calculations, though, so you don't get confused and mess up some basic algebra. So we don't want any mistakes being made that'll cost us points needlessly. Okay? So now we'll move on to the next question. And in the next question, what we're looking at here, number 2, is how we deal with the Tomas Company information. So in this case, what we did on March the 3rd is we accepted this note. So we made a note receivable. So we increase that with a debit. Notes receivable is an asset, and assets increase with a debit. And that will be for the full $18,000. The next thing that we're going to do is eliminate this accounts receivable, because they told us this was a time extension on the past due account receivable. So we're eliminating the accounts receivable and reclassifying it as a notes receivable. Okay? And that's all that's going on in number 2. So now in number 3, what we're going to look at is on March the 17th, what happens with the H Chang information, and the answer is the exact same thing. So in this case, instead of $18,000, it's just for $16,000, but it's handled exactly the same as the transaction on March the 3rd that we just discussed. Now on April the 16th, we're told that H. Chang dishonored his note. So on this date, what we've got to do is we have to eliminate the note receivable, accrue for the interest revenue, and restore the accounts receivable. So what just happened is we decreased the notes receivable down to 0, eliminating it. So let's just track our notes receivable for Chang. So what we did have was $16,000 as a debit, but when he dishonored that note, we now credit that account for the same $16,000, and it leaves us with $0 as a debit in our notes receivable account, or you could say it eliminates that account, and we are now restoring the accounts receivable balance for him, and we similarly need to accrue for the interest related to that period of time. Now, what we're going to have to do after that, after we've dealt with this issue on April the 16th, is look at May the 1st. So on May the 1st, what we see is that we have a write-off of his account against the allowance account. So in this case, what we're going to have to do is look at what amount was in that accounts receivable account. And it was this $16,080. And if he now tells us he does not intend to pay us, that has to be reduced by the $16,080 to bring us to a 0 balance in accounts receivable. So the way that's going to happen is, 1, with a credit to accounts receivable, like we see in our T account right here, and 2, by taking this out of my allowance for doubtful accounts. So allowance for doubtful accounts is going down, and accounts receivable is going down as well. And so that brings us to the last journal entry here on June the 1st. And on June the 1st, what we see is that we received the Tomas payment for the principal and interest on the note dated March the 3rd. So in this case, we say, well, how much was the note for? The note was for $18,000. So the first thing I would do is fill in that note receivable as a credit, because it now has to be decreased because the customers paid us. And because they paid us, they no longer owe us any money related to this note. The next thing I would do is look at how much interest should have accrued on that note, and in this case it was the $270 that we calculated earlier. And if you want to see that, just scroll back up and you see the $270 related to the Tomas company note. So we now know where this $270 came from. And finally, the cash received is just the $18,000 of the actual note plus my $270, which brings me to $18,270 for total cash received. And you see that right there. And that brings us to the end of question number 9. And together with 9 and 8, we have completed this series related to this information. So we'll move on to the next section of the homework. Now, for number 10, what we want to look at is something a little bit more straightforward than all that we've been doing up until this point. And this is what's called calculating the accounts receivable turnover ratio. Now, throughout this semester, we look at quite a few ratios, and this is just one more. But hopefully, once we get done looking at it, you'll understand how it works, and it won't feel too intimidating. So the way that we're going to calculate my accounts receivable turnover ratio, which I'm going to abbreviate as ARTO, is I'm just going to take my net sales for each year divided by my average accounts receivable, and that will be net accounts receivable. Okay? So what this is telling me is I can rewrite this as net sales divided by current year accounts receivable plus prior year accounts receivable divided by 2. And that's exactly how we're going to do this to get this math to work. So what I'll do is I'll first come in and I will look at the information that I've been given, and it tells me here that the following information is from the annual financial statements of Rahim Company. So it says that net sales for year 3, for year 2, and year 1 are $243,000, $174,000, and $226,000 respectively. Now for accounts receivable net at year end, they are likewise $41,700, $39,500, and $36,200 at the end of each year, respectively. So what they want is they want me to calculate accounts receivable turnover for year 2 and accounts receivable turnover for year 3. So we'll first handle the year 2 calculation. And in this case, I will take net sales, which if we look for year 2, my net sales figure is in this column right here with the arrow, and it is located right here. It's just $174,000. So I'll just drop that straight into my formula, and then I will divide by my year 2 and my year 1 ending accounts receivable. And you'll find those numbers right here that are now highlighted in yellow. So that will be $39,500 plus $36,200, and we'll divide that by 2. And when you do this, what you get is 4.6 times. Now, that is what our accounts receivable turnover for year 2 comes out to be, is we are turning over our accounts receivable approximately 4.6 times per year. So now we'll do the exact same math for year 3. So for year 3, what we're going to do is I'm going to take my year 3 sales number of $243,000. I will then divide that by my accounts receivable for years 2 and year 3 by that average, and this will be $41,700 from year 3 plus $39,500 from year 2, and we'll divide that figure by 2. When I do that, I will come out to 6.0 times that I'm turning over my accounts receivable. So year over year, I went from 4.6 times to 6 times. Is this an improvement or is this worse? This is an improvement. So be careful when you answer the next part of this question that asks you if they're doing better or worse. Because if you just look at the change, your answer would say they are doing better. But the question does not ask you it in that manner. Instead, what it says is, assuming its competitor has a turnover of 9, is Raheem performing better or worse than their competitor at collecting receivables? And in this case, you want accounts receivable turnover very high, because the faster you can turn over your accounts receivable, the more times you can do this each year, the more effectively you are collecting that money. So we would like this high. Even though we have improved year over year, we are actually performing worse than our competitor because 6 is less than 9. So while we are turning over our receivables 6 times per year, our competitor is successfully turning over their receivables 9 times per year. Given the choice, all else equal, what I would prefer is to turn over my receivables 9 times per year. So that is the end of number 10, and with that we'll move on to the next question. All right, so in question 11, we're once again going to look at how do we calculate the amounts for bad debt expense and for our allowance for uncollectible accounts in several situations. So hopefully at this point in this video, if you've been following along, you're getting fairly comfortable with this. But we'll walk through it the same way that we have up until this point just to make sure that we understand exactly what's going on. So in this question, it tells us that at December 31st, Hawk Company reports the following results for the calendar year. Cash sales, $1.4 million, roughly, and credit sales, roughly $3.1 million. They then tell us, in addition, its unadjusted trial balance includes the following items. Accounts receivable for $936,000, and allowance for doubtful accounts of $25,790 as a debit. Okay, so just like we did earlier, we'll deal with this twice with income statement methods and once with a balance sheet method. Okay, so if you remember the rule for the income statement method, we calculate the adjustment. But with the balance sheet method, we calculate the ending balance in the allowance account. So what may be the easiest way for you to remember this is that the balance sheet method gives you the balance, whereas the income statement method gives you the adjustment. Okay, so however you need to remember that is fine, but do remember for these first two methods, we will ignore beginning balance in our allowance for doubtful accounts for the journal entry portion. Okay? So we do need to remember that. So now we'll clear out all this just to clean this up a little bit, and then we'll dig into the numbers related to this question. So what we see here is for situation A, they say, bad debts are estimated to be 3% of credit sales. So be very careful that you read that closely, and you do see that it is just the credit sales. So what we'll do is we'll come up here, we'll look at the given information, find credit sales, $3,088,000. So this is $3,088,000 times my percentage, which is 3%. And when I do that, what the math will come out to is $92,640. And we plug that amount directly into my journal entry. We do not need to care what this balance is in allowance for doubtful accounts under an income statement method, because allowance for doubtful accounts is a contra asset that is found on the balance sheet. So it wouldn't make sense. So we just drop this straight in. So we debit bad debt expense just like we've been doing, and we credit the allowance for doubtful accounts for $92,640, and transaction A is done. Now for transaction B, we're going to do something very similar. And in this case, what we're going to do is, instead of just using the credit sales, now we're going to use cash sales and credit sales. So now I'll come in and I'll take my credit sales of $3,088,000. I'll add that to my cash sales of $1,431,190, and I'll multiply that combined number times 2%. So when I take that times 2%, the number that I will get is $90,384. And that number will now be dropped directly into my next journal entry. Okay, so the income statement method, fairly straightforward because it's really just that one calculation. And that's it. That's all there is to this question for the first two pieces. Now for the third part, this is the one that takes a little bit more time, but hopefully still not too terrible, especially at this point. Right? If it is, just make sure you rewind this a little bit and go back through it. You'll get it. So the last piece here is where we're dealing with the balance sheet method. So in this method, it tells us an aging analysis estimates 6% of year-end accounts receivable are uncollectible. As soon as you see they're basing this on accounts receivable, that tells you this is a balance sheet method. These two were based on sales, and that word sales, when that's the basis, tells you that's the income statement method. Okay. So we'll clear this out again, just to clean this up some. And now what we're going to do is I'm going to take my ending accounts receivable balance, which is at $935,664, and I'm going to multiply that directly by 6%. When I do that, I will get $56,140. So the easiest way to get this question right is to take a few seconds, draw out your T account, and see that in your allowance, you have a beginning balance of $25,790 given in the facts above. You now need your ending balance to be $56,140, and just for completeness, we will include what else could land in this on the debit side if you had any write-offs, and on the credit side, this is where we'll put our current year bad debt expense number. So how do we get this number right here? Well, the easiest way to visualize this, I think, is with a number line. So we'll go back to this method. So we'll start with a $25,790 balance for the debit side. But by the end of this, we need a $56,140 credit balance. So the way that we're going to get here is I first have to cover this $25,790 gap to get to zero. I then have to cover an extra $56,140 to get to this new balance. So the actual amount that I'm going to use here is going to be this $56,140 that I need at the end, plus my beginning balance of $25,790, which will give me my adjustment for $81,930. This amount right here that we've just calculated is then pulled back into your journal entry. The accounts, once again, are the same as they have been all the way up until this point in the video, so I'm not going to rehash that again. Now, just for the sake of completeness, and because none of the questions so far, I don't believe, have done this with an already credit balance, what I'm going to do is I'm going to rework this down at the bottom, but I'm not going to do it in blue like I've been doing. I'm going to do it in red, just so it stands out, and maybe you'll realize this is a separate question. Okay, so this is an alternate situation. And in this alternate situation, my allowance for doubtful accounts will have an ending balance, or will have a balance, my beginning balance here will be a $25,790 credit. So it'll be a little different than what we did a second ago. So in this case, when I draw out my T account, what I'll see is that my allowance will now have that beginning balance on the right side for $25,790, and I still need to get down to this $56,140 as my ending credit balance. Well, in this case, the way the number line is going to work is we're already on the correct side of the zero, right? We're already on this credit side. So I just have to cover the difference between $25,790 and $56,140. However large this difference is, when I take $56,140 less my $25,790, that will give me the amount of the adjustment in this case. I apologize, I did not do this beforehand, so I'm going to jump over to my calculator really quick and calculate this for us. And if I did this, and I did the math correctly on my phone, then the amount of adjustment I would need here would be a $30,350 adjustment instead of that $81,000 adjustment we saw previously. So just be aware, right? If you're going from one side of the T account to the other, you're going to need a whole lot more than if you're already on the correct side. So that was just for the sake of completeness, just to give you that example, because you never know how you're going to see it. But now that we've done that and we've finished all the required steps for number 11, now we're going to move on to the next question, which is number 12. And we're getting close to wrapping up this homework assignment. So for number 12, which I accidentally cut off, so I'm just going to go ahead and work it out. I'll just draw out exactly the way this should have been shown. But the way this is going to work, and I'll just put it in on just a sticky note here, is, and this will be for number 12, right? So this is for number 12. What I'm going to do is I'm going to show you what they asked for on 12. And on 12, they asked for the balance sheet presentation given the facts in Part 1A. So use facts, part from Part A of number 11. So if we're using those facts, then what I'm going to need to first do is, so this is going to be in the current assets, the CA, the current asset section of my balance sheet. I'm going to list my accounts receivable, $935,644. I'm going to back out the amount in my allowance for doubtful accounts. This will be $66,850. And that'll bring me down to my bottom line number of $868,814. Now, what you may be asking is, where did this number come from? And this is the question I hope you're asking, because that number is not directly given to us. What we've got to do is go back up to number 11, and we'll see that the amount of the adjustment we made in A was $92,640. And that was a credit. But we began with a debit balance of only $25,790. You see that right here for my allowance for doubtful accounts. So what I know is that then I need to back out that $25,790. And when I do that, what I'll come down to, in fact, is my $66,850 that we plug in right there. So hopefully that makes sense now that we've looked at it. And now we'll move on to number 13. So number 13 says, well, we want to show how accounts receivable and the allowance appear given the facts in Part 1C. So Part 1A was based on just credit sales. Part 1C is based on the balance in accounts receivable. So what we see here is that my accounts receivable balance, that gross number, is the same as it was in the question we just worked. But now the allowance for doubtful accounts is a different number. And that's because in this case, all we needed to do was to take that to take my ending accounts receivable number, which is this right here, times the percentage that we expected to go uncollected, and that gives me my ending balance in the allowance. So in this case, now this one's actually easier because I can just pull this 56 straight from there directly into my calculation. And that's all there is to it. So hopefully not too bad. And now that we're done with 11, 12, and 13, we'll move on to the last couple of questions and finish this assignment. So for problems 14 through 16, these are all related. And we're going to just walk through them one at a time. Okay? So the very first one tells us that we want to prepare an aging schedule for accounts receivable to estimate our bad debts. Now this is another method that is considered a balance sheet method, and that is because it is still based on accounts receivable, and accounts receivable is still found on the balance sheet. So this tells me on December the 31st, Jarden Company had an allowance for doubtful accounts that has an unadjusted credit balance of $15,000. Jarden prepares a schedule of its December 31 accounts receivable by age. So all they want us to do is to fill out this table. So while this looks like a bunch of input is required, it's probably the easiest question on the homework assignment, because all you're doing is taking the information straight from this table. One second. Straight from this table right here. And you're just dropping it in this table right here. So you just say, well, what's my accounts receivable that was not due yet? So not yet due, not due. I take my 840. Goodness gracious. So I take my 840,000, that's right here, and my 1.3%, and I just drop them in their respective locations. And then I go ahead and do the math on that. And I follow this procedure down through the rest of this table. And when I take the multiplication of each set of numbers, so 840 times 1.3%, 336,000 times 2.05%, and I do that on down the line, then what I'll end up doing is taking the sum of all of these products, and I will get $42,572, which is my estimated balance of the allowance for the uncollectible accounts. And that's all there is to number 14. Now, number 15 wants me to actually do the journal entry. So in this case, what we do is we said, well, what was my beginning balance in allowance for uncollectible accounts? So my beginning balance was $15,000 in this allowance T account. Then I've got to add in my current year bad debt expense to get me down to $42,572, which is my ending balance. And the only thing I would have over here typically is my write-offs, unless my beginning balance happens to be a debit. So now what I need to say is, if I looked at this on my number line like we've been doing, what I would do is I would start over here at $15,000, which is already on the right side of the line, so I don't need to cross sides. So now I need to get to $42,572, and this difference right here is exactly $27,572, and that will be the numbers that drop into my journal entry. And once again, it's just a debit to bad debt expense and a credit to allowance for doubtful accounts. So hopefully not too bad there. Now number 16, it tells us on June 30th of the next year, so notice that it says that, Jordan concludes that a customer's $5,400 receivable is uncollectible and the account is written off. Does this write-off directly affect their net income in this year? And the answer here might surprise you, and the answer is no. And the reason it is no is because the entry to write off this account is a debit to allowance for doubtful accounts, and a credit to accounts receivable. Now, where are both of these accounts found? Well, they're both found on the balance sheet. This is a contra asset, and accounts receivable is an asset. Since neither one of these items are on the income statement, we can therefore say that this does not directly affect net income, which is calculated on the income statement. So we can tell that there is no impact in this current year where that actually gets written off because that expense is incurred in the previous period when the revenue is generated. And that takes us through to the end of the homework. So that's the end of Chapter 7's homework on valuation of accounts receivable. Hopefully that helped. If you have any questions, always feel free to contact me and let me know that. Thank you. I'll see you again next time.